we've got a lot of lead up. Now we're talking about the actual raise. We'll talk about the kind of the biggest pieces we're going to go through: debt versus equity, employee comp. I'm going to roll through kind of an example term sheet that's in your book that we've used. We'll talk a little bit about negotiations and then managing the close, which I always tell people managing the close is the most difficult part because you're out of energy and it's paperwork, but we'll talk about some strategies for that. I get this question all the time from clients of, should we do convertible debt or should we do equity? Obviously there's sort of, as all decisions require, there's kind of pluses and minuses to both. This is what I want to cover in this section is, if you're going to be raising one or the other, why do we use one convertible debt specifically? And the second decision that we really have to make is, if we decide to sell equity, are we selling common shares or preferred shares or the equivalent for units, right? And let's talk about the characteristics of each, and then I'd be happy to take any questions. Common equity, so common shares or common units if you're an LLC, are sort of the easiest thing to get your head around. And basically what that means is usually the founders of the company have common rights, meaning they get to vote on most everything, but it's kind of the lowest level of rights that you're going to have in a company. And I don't want to say lowest because all the important rights are there. If you sell the company, you get distributions of cash. For the most part, you've got representation on the board. All those kind of things go with common equity. If I tell my clients if they can raise with common equity, especially in the early rounds, they should. The more rounds of preferred equity, and especially if you use more than one class of preferred equity, it just leads to more and more complexity as you go down the road. The common belief is if you give some right away in this round, you're probably going to give that right away plus some in the next round. And so, if you can start with common, I think it makes the most sense. However, most of the time investors, when they come into a company, they want to de-risk their investment as much as they can. And they de-risk that investment by taking some preferred rights compared to the common. And so the most likely preferred rights that you're going to be getting are preferred liquidation rights. So a preferred liquidation right, just think of it this way, is when you're giving that right away, what it says is, okay, you've got a great idea, you've got some implementation, you want me to invest money in your company and you want me to own 20%. Say you want me to put $500,000 in your company. If we come in as common, I put $500,000 in your company and you give your idea or whatever to the company, and say it closes down, you sell, tomorrow for $300,000, right? Say you decide, hey, this is never going to work, I'm going to sell the company for $300,000. If I come in as an investor and I put my $500,000 in and we're all common and I own 20% of that, what do I get for the $300,000 that goes out? $60,000, right? So an investor says, look, I'm not going to take the risk that we have like, a foul ball or maybe even a base hit, right? Say we have a base hit, I put in $500,000 for 20% and we sell the company for $1 million, right? I still don't get my $500,000 back if we come in as common. Does that make sense? Because we just share proportionally. So investor says, look, in order to protect myself, I know that you've got your idea and I've got cash, and cash is always more important than the idea, at least from the investor's perspective. I'm being a little facetious there. They're going to say, yeah. So what they're going to say is, look, if we have the base hit, I want to at least get my money out first. Right? And so they'll ask for a preferred liquidation preference. And for the most part, I don't have any problem with that. That helps them. It still aligns your interests, and it just says, look, if this doesn't work out, I at least want to get my investment back. I don't want this to kind of crater and then pay half of the cash that I gave to the company to you and let you walk away with it. Right? That's just what they're going to do. Now, the thing is, one thing that I do push back on that you'll get some investors will want are what's called participating preferred liquidations. And the difference between that and a preferred liquidation is a participating preferred says, not only do I get my $500,000 back, but then I also want 20% of what's left, right? I'm not saying that you never give that up. You have to look at the economics of any investment, but keep in mind that that's an order different than the preferred liquidation. The first one, preferred liquidation, just protects the investor that they at least get their money back, and they can decide whether they take their 20% or whether they take their initial investment back. Does that make sense? Participating preferred gives them both sides of it, right? If you get the right deal for an investor, you can say fine, you got to run the numbers to do that, but keep in mind that those two are not the same. A lot of times an investor is going to take a dividend right, meaning that they have a preferred dividend that gets paid to them before it gets paid to the common. And this is like a built-in return, right? Keep in mind, I get this question pretty frequently, you are not, if the deal is structured properly, you're not required to pay that every year, but it just continues to accrue and is a built-in return for that liquidation preference, okay? And so what I feel like with these is that a lot of times people get focused on this dividend payment. I think if you run the numbers, I'd rather give a high dividend than give a participating preferred liquidation. But I can't tell you that with 100% certainty because you got to run the numbers to see. But that's frequently one of the rights that's given to a preferred round. Another right that's frequently there is board representation of some kind or another. And that basically is an investor wants to either have a person on the board that's making decisions on behalf of the company as part of the board, or, which is becoming more and more frequent, they want what's called board observer rights. Okay? Board observer rights means that they get all the information that the board gets, and they either, they get the board packet, they do all those kind of things, but they don't actually vote. The reason that they don't want to vote is they're not doing you a favor. They don't want to have any fiduciary duties to the company, okay? And so the reason that's important, this is not like a scam by them. This is not the investor trying to pull one over on you. The reason that they're doing that, if they say, I want to have a board representative that gets to watch the board meetings, they want to know what's going on. They want to give their input to that. They don't want fiduciary duties. And they're going to rely on kind of the other protections that they put into your term sheet or in your purchase that says you can't sell the company without my consent and those kind of things, right? So, I have clients who sometimes ask about that. I don't have a preference one way or the other. I do tell you that if they're actually on the board, they have fiduciary duties to the company, and some larger funds just don't want to have that.
Boards are typically voted on by shareholders. How do they bake that board seat in there? Is that just something that's separate from the normal?
Two ways. So the two ways that you will do it is either you alter the articles for the company that says that all the preferred holders get to vote on one director. And so, and that's typically either one holder or one predominant holder, and they'll elect their person. Or in the shareholder agreement, they'll make the founders agree to put that person on the board. So those are the two ways it's usually done. It just depends on the structure of the investment. Preemptive rights. So frequently investors want what's called preemptive rights. Now there's two kinds of preemptive rights. One is perfectly acceptable and is really beneficial to you as a company, and the other is absolutely unacceptable and should never be agreed to. And they're both called preemptive rights. All right? Gotta love it. Gotta love it. Okay, here's the one that you say okay to every day of the week, right? This is like, I'm a Packers fan, so this is like the one, like, if you win the flip, you always defer. You don't say, receive or kick, right? So this one you say yes to. It's like saying deferred every time, yes. Preemptive right is, I agree to let you buy your percentage of the next round of equity or every other round of equity on the same terms as everybody else. Okay? That's a preemptive right. That's totally fine. The first person you're going to call when you get to your second round, for the most part, is the person who invested in the last round, right? If they're buying on the same terms as everybody else, your interests are aligned, okay? And that's perfectly fine. A lot of investors look at it as a long-term investment. They realize you're going to raise more money, and what they don't want to have is have a company that's going really great and have you guys be seduced by some bigger firm that like has better parties or something, and let them buy the next round of your investment when you're on the way up, okay? And so that's perfectly fine. You give them that right. If they may use it, they may not, that's fine. The one that you never say yes to, I try not to speak in nevers, but this one I just think doesn't make any sense, is I agree to give you 10% of my company forever, right? That's not the way that they're going to put it, but they're going to say, I get 10%, I get 10%, I get 10%. It doesn't matter how much money you raise, how big you get, I get 10%. That is an irresponsible way for them actually to structure a deal, because I can tell you, no investor is going to let that stand. Like, you're not going to be able to raise money from a subsequent investor if you have that term in there. I've negotiated that out several times with clients. You almost always give the investor a larger percentage of the company in exchange for them giving up that right. They're not happy, you're not happy, but at the end of the day, an investor is not going to invest behind that.
And honestly, if somebody asks you for that, then they're a rookie. They don't know what they're doing.
Yep.
That's ridiculous.
Yeah.
They're not a pro.
Yeah, and that's the thing about it, is it's almost always very early stage. It's just hard, it's one of those things that just, they need to continue to deliver value if they're going to get more value. Go ahead, Trevor.
What about if you have something like that for an employee? Or is that like something you typically don't have in a contract, but you give them more options when you raise a round to keep them undiluted?
You can give them more. I mean, you can have agreements with an employee that says, hey, if we hit this milestone, meaning we get to the next round, I'm going to bump the number of options that you get. That's okay.
But is that like the first preemptive right rather than the second?
It's not really a preemptive right. It's not that. I mean, it's a. Depending on how it's structured, that's okay. A preemptive right, I think, is when they can buy back in. That's really just like a performance bonus. The thing I wouldn't do though is if they don't have any, if they don't push the needle on that, I wouldn't give it to them. You know, for example, like, if there's somebody who runs a production line, you don't give them a bonus based on the sales department, doing something, right? That's just one of those things where I line it to somebody that makes sense.
Okay.
Yeah, nothing wrong with that.
I think also on the investor side, you'd likely get pushback on like why would you do that for this employee, unless there's like, the company's gonna literally fall apart if you lose them if that's not met type of thing. That's dramatic, but I think future investors aren't going to want you locking into a structure like that.
Because investors do want to make sure that, and that's like the same kind of canary in the coal mine. Do you make good choices about how you compensate your employees? Shows your choices on all sorts of other things.
Yeah.
So that's a good point. Any other questions? All right, let's do convertible debt. All right, safe notes are the same thing as convertible debt. Okay, who has experience with safe notes? Okay, just Mike, that's okay. They're coming, I have more and more dealings with them. They are just convertible debt, like anything else. They've got different terms, but I get this question a lot. They work essentially the same way. You're supposed to not change the terms of them, but people change them all the time. And so they operate the same way. Here are the important terms that you deal with convertible debt, and we want to talk about them because the thing about convertible debt is a lot of companies use it early on. It's more complicated to kind of pro forma the impact that it has on you, and so don't structure convertible debt if you don't have any experience doing that. Talk to an investor, talk to an accountant, talk to an attorney, because you have to, there's a lot of moving parts in a convertible debt that might not make a whole lot of sense up front of what the impact is. So here are the terms. You're going to have an interest rate. A lot of safes don't. so that interest rate's 0, but you have an interest rate, right? And that's straightforward. You have typically a valuation cap. Okay, we'll talk about each of these in sequence. A valuation cap just basically says, if we go to the moon in value before I convert my debt, I don't want to convert, if I put in early money on a convertible debt and you guys win the unicorn lottery, I don't want to convert my $100,000 plus 8% interest into like $1 billion valuation. I want my investment to act more like equity at that point. And that's what a valuation cap does, and I'll talk through why that is. The other important term that you have to keep in mind is conversion triggers, which is what are the events that happen that actually convert my debt into equity? Because most of the people, I would say, unless they're a very unsophisticated investor, do not want you to ever pay back the principal and interest on a convertible debt, right? That's the backup, that's like the liquidation preference, but the intent is not to pay it back. The intent is for it to convert into equity in the future. And then the third piece is maturity date, which, like I said, is usually just a triggering event date that we'll focus on. I forget if no, I didn't go into this. Okay, so here's how these terms work at a very high level and how you should pay attention to them. Interest rate is essentially irrelevant, okay? I say essentially because if you pro forma the numbers, this is not the biggest piece that'll govern how much dilution you have, unless the interest rate's like 25%, right? I would say in our market it's commonly like 8%, 8 to 10, which is an interest rate that for an early stage company no bank would ever lend on, right? But this isn't real debt, so we put it in there. That's like a built-in kind of gain figure, right? So interest rate is not that relevant compared to the valuation cap. So let me show you why a valuation cap makes a big difference. If I gave your company $500,000 in convertible debt, right? And you have the choice, you can check me on my math later, but you have the choice, and we know for a fact that I'm going to raise money next year at a $10 million valuation in 1 year. I would guarantee you that you'd rather pay a 50% interest rate than you would having a $1 million valuation cap, okay? Because what that means is, regardless of how much money you raise what valuation you raise money at in the next round, if it's over the valuation cap, I convert my equity as if it was at that cap, right? So instead of me converting at a valuation of $10 million, I should have put an example in here. I feel like I'm like standing here with my arms in a way that is totally irrelevant to you. What it says is regardless of over that amount, you convert as if the company was worth $1 million. So if that was the case, when I put $500,000 into your company and I convert at $1 million valuation cap, I get 50% of your company, okay? Regardless of whether you raise money at a $20 million valuation, a $50 million valuation, I convert as if the company's only worth $1 million. And from a dilution standpoint, that's more significant than any other kind of term that you'll have, like an interest rate. All right. So when you do that, you have to actually put pencil to paper and kind of work through, right? Because what happens then is that if your company really goes up in value, your investor is going to end up owning a bigger percentage. Okay, and that can discourage later investors from coming in. Does the mechanism of that make sense?
I think what you're saying is on the interest, I pay 50% interest, and they give me $500,000, and I give them back $750,000. But on the latter one, they put in $500,000 on $1 million cap, I raise it $10 million, they get $5 million worth of shares for $500,000. Yep. So I just gave up $4.5 million in cash, basically.
Yeah, you're exactly right. That's a much better example than interest rate.
That's brutal.
I'm glad that you're a math guy. So I'm just a lawyer. Yeah, so that's exactly it, right? Is you've given up a lot of value. The third, go ahead.
I was just going to add one thing that you said, but I think is really important. Is the thing to really think about, both whether it's a note, verbal note, or a safe, is that because these are hard to measure the impact in a future round, you have to be really, smart about not just layering on, okay, I'm just gonna, raise a $100,000 note here and then another $500,000 note here. It makes it very difficult for a future institutional investor to, they get worried about that layering over time and the impact on valuation. So you have to run, it's hard to run the scenarios on that, but you need to do it. Just something to, you said it and I wanted to
I appreciate
emphasize it.
Yeah, and I actually have, I'll have to dig it out. I did a spreadsheet that I've used with different clients that works through kind of this piece of it, but it is, the math on it is not hard math, but it's a little bit complicated if you've never done it. So I think I've beaten this to death. I apologize, I know that I'm eating into time. If you're gonna do convertible debt early on, no problem, people do this a lot. The trade-off is you don't have to set a valuation or up front, but I'll tell you that there's more ways to make mistakes on the terms of convertible debt than there is to make mistakes on equity. So if you're gonna do it, make sure you work with somebody who knows what they're doing. Okay, questions? Let me jump into equity.
Sorry, just one quick question. So my understanding, for the reasons you just described, that convertible debt with safe notes is, I don't know if it's the most common, but not only very commonly used in early rounds, but I guess what I'm trying to understand is requires a little bit of sophistication from the investor as well. So are you limiting your investor clientele if that's the route that you're going?
I think I have to explain it more when it's used early stage. But a lot of times the people who are pushing for it early stage are not the friends and family, it's the angels that like your company and don't like the arm wrestle of what the valuation is.
Okay, so it's not so much used in friends and family?
I wouldn't. I mean, with friends and family, I mean, that's like is frequently the least economic negotiation that you'll have. And so they, frequently they'll come in with common equity in the company, and it's really more driven by, how much they like you and how much cash you need. I mean, that's the reality. I'm not saying that there aren't outliers, but I would tell you that I try to avoid it with friends and family and just do common. But angels, I think angels who really like your company, who think that you can't get together on a valuation, that's the way they back it up. And unlike the questions before, I mean, there are metrics for valuation, there's background, but ultimately, as I tell people, it's an arm wrestling match. I mean, how good of a negotiator you are and how much do people want to invest in your company. I just had two guys come in the other day who are brothers, and I'm on the phone with them. And sometimes, my wife tells me I shouldn't say this kind of stuff to people, but I'm on the phone with them, and he's a really nice guy. And he'd tell me he and his brother are starting a company, and they can't decide whether it should be like 60-40 or 70-30 or whatever. And he says, ask me what I think, and I asked him, who is a better arm wrestler? And it was in the middle of this long conversation about stuff, and he is like, excuse me? And I said, yeah, like, if you guys had to do it right now, who would win? He's like, I don't, they're adults, like it was last time they did it. I said, I'm just illustrating a point that a lot of this is, there's no right answer, it's just like who's better at pushing one of the other ones over. So, but the nice part is that you can avoid that with convertible debt because you kick it down the road. But like I said, it gets more complicated structure-wise. Any other questions? Okay.